Hey guys, welcome back to the Capital Mindset Show. So today, like I promised, I'd be getting you guys a couple videos out. And for those of you who haven't seen the Strongman Personal Finance live stream, I was there. You probably saw me in a robe. That was the attire for the evening. We had a couple of drinks, we enjoyed ourselves. And, on those live streams, you get to see me in a different light, less professional light. And just have fun. All right, so today we're going to be talking about Tattooed Chef. So Tattooed Chef reported earnings today, and I actually want to showcase with you guys here and talk a little bit about that. But you can see what happened throughout the day. They were down about 4.94%, only to actually come down another 6.79% after hours. Now, we'll see what happens in the morning, but we'll talk about the earnings. So also, again, to show kind of an accountability for myself, we're going to actually discuss and showcase a little bit about some of the things I stated in the past, going back all the way to the beginning and seeing if any of my points or any of my concerns have changed. Now, for those of you who are new to the channel, or new to the stock, I'll explain a little bit about the stock. So Tattooed Chef is a frozen vegetable food company. They have two business lines that you have to be concerned with. They have known as the white label. White label, for those of you who are newer to understanding about the difference between white label and actually branding products. White label is the non-branded products. There's the ones that you see maybe at Walmart, and they might actually have let's say the Great Value brand at Walmart. Or with Costco, you might have Kirkland, for an example. All right. And then they also have the branded product. So the branded product is maybe what you're familiar with. If you go to a Target, they have the, actually, let's open this up and kind of show you guys what they look like. So you have, they usually have this logo up at the top. Well, this kind of pattern that you see here. So let's go to the bowls. So this is the boxes. You'll see these boxes in the frozen food section. You have cauliflower, mac and cheese. And if I'm being honest, the only one that I'd probably eat is that one that I've tried out of curiosity. That's the only one I kind of like. It's okay. It's pretty good. Aside from that, that's pretty much what this business does, and we'll go over again some of the things that management has stated. But as I kind of said, we're going to go over some of the reports. So they grew revenue by about 37.3%. Okay, so let's start off with that. Off on the surface, it does appear as though that's strong revenue growth, and I'd say that that's decently strong, but revenue growth isn't everything, right? And we've discussed this in the past. Revenue growth is not everything. Now, branded products, this is the key. Branded products only grew at 21.2%. So they achieved about 43.5 million, which is about 60% of total revenue. Now, adjusted EBITDA, right, our favorite metric, it was about 13.4 million. So that's the operating income right there. And a net loss of 17.6 million. All right, so let's digest all that. Where is the crux, or where is the issue here? Well, it's in the growth in the branded products. So if you actually take a look and actually see who's talking about Tattooed Chef on YouTube. Now, you type in Tattooed Chef stock on the YouTube search, and you'll come up with this. So actually, I'm actually proud when this happened that other people are coming up besides the main promoter, you could say. So that would be this guy over here, and he gets a lot of views. You can see the amount of people that have seen this. I don't know how many of those people have invested, or how many of those people watch it for perhaps some form of entertainment. Now, I don't know if this is because YouTube is suggesting this to me, but there's also some dedicated channels such as this one over here. And so, again, I might say it is easier to kick it while it's down, but there have been plenty of people that have not been kicking while it was down and actually kicking it while it was up. And I got to give credit where credit is due. Everything Money was actually one of them. So, and then there are some other creators down here that you might see. And then Strongman Personal Finance, which is, I go on his live streams. He's been calling this out for quite some time at this point. So, with that being said, what are some key points or some key bullish points that some people would say? Well, they look at the SKUs. A lot of the research I see done is, they look at SKUs and they look at the stores and how many SKUs are in each store, and maybe they see someone buy it or something. Well, all of that is anecdotal evidence. And in the world of investing, in the world of science, in the world of anything that we measure where we do any form of statistical analysis, subjective or anecdotal evidence can be very problematic to when we develop a thesis and then from there actually try to derive a valuation on a stock. So if you think about it in terms of predicting sales growth, how reliable will you looking into a store and seeing how many SKUs are there, how reliable is that at predicting sales growth? Maybe it can give you an idea of there's some semblance of growth, which there has been growth, no doubt, as we've been stating. The growth has been about 21.2% in the branded products, right? But 21.2% isn't what these other creators have been stating as being part of the thesis. They have been expecting greater sums of growth because, and why you might say, well, they grew at 37%. Why is that not okay enough, right? Well, it's because the branded product is where the margins actually are. You want to make sure the company is selling more and more and more of those branded products. And if that slows down in any way, as we're kind of seeing here, that is a little bit of a concern, okay? So because the white label products, they're not that profitable, okay? They can drive a lot of sales volume, but they're not that profitable. So that's a little bit of a problem. So I'm going to show you guys some old things that I used to state about this company, going back months, almost since last year. So we'll see some of those statements now. So here are some thoughts I want to share with you about the potential for inflation risk. Oh, entirely, because the profits are determined by what pricing they can get on that distribution channel, because that goes into the cost of the business and then will translate to how much money they end up keeping on the bottom line. So yeah, they need to stabilize those costs. If they don't, then they're going to be leaving themselves wide open to inflation. So anyone out there who believes inflation is coming, and this episode's not about inflation, but if you're one who believes that, then you're opening yourself up to a lot of inflation risk here. All right, so that was actually a video from October 9th, 2021. And these were some of my preliminary thoughts on the company. I'm also going to be sharing with you guys my valuation estimations around that same time period. So to give you guys an idea, I just kind of skipped over for it, and I found that it was at minute 40, okay? So just to save you guys some time, because I expect everyone to go back and watch this video. But taking a look at what we kind of had here, you can see the price ranges right there. And so it ranged from anywhere from $2.74 to anywhere upwards of $38.59 in the most extreme example, which assumed a high level of revenue acceleration in terms of growth from where we were then. And in fact, what we experienced since then is actually more in scenarios 4 and 5. So scenarios 4 and 5 are actually becoming more and more probable. And actually, remember the growth rate I stated, we are seeing that deceleration. And so scenarios 4 and 5, if you actually watch this video, are the ones that are actually coming to fruition. And those were the ones that I actually stated were the most probable, in my opinion, based on what I was seeing. And because if you actually played, again, this full video out, you would hear some of those thoughts. There are more videos on the channel about Tattooed Chef. And again, the purpose of it is just to share my thoughts on the company, because it is a widely talked about company. It does get a lot of coverage from the larger channels. And so I think now it's getting dogpiled, and it's deservedly so, by the way. It's getting dogpiled. I'm not going to say that, it doesn't deserve what's happening to it, but I will admit that at least. And then there's another video I'll just highlight super quick. It was posted on March 18th, 2022. This video was an updated valuation, kind of revisiting the company and, seeing if anything's really changed. Well, in summary, nothing really had changed too much. In fact, there was perhaps a little bit of deterioration. I went a little bit more aggressive in my valuation in this one than actually the previous one. And I actually assumed greater levels of profitability, but to make a point. And what I kind of did in the theme of this video is I compared it to Conagra Brands, which is the large player in this field. And so you have Tattooed Chef, Conagra Brands. I'd say Conagra Brands should be what Tattooed Chef's goal is. And maybe that is their goal. But, in this instance, I was a little bit more aggressive. But still, you see the price targets there. It's not really price targets. Those are price points of interest. We range from anywhere from $4.87. In this case, it's actually labeled as Scenario 1, all the way to $25.74 and Scenario 5. But Scenario 5 being the least likely, and I ranged it, or I scaled it by probabilities. All right, but essentially it was still around the realm of overvaluation. Now from today's price, we actually reached Scenario 2, below Scenario 2, which was an assumption of 33% growth. You can see that the growth rate has been decelerating, and that was a big risk, right? And so the growth rate with the branded products is the most problematic, because now the branded products, again, that's where the margin's at, is growing in the 20s. And that's a bit of a problem, because you need this company to grow somewhere in the close to the 40s, because at the end of the day, you can't pay bills with revenue. The growth rate has to be applied to the cash flows or the net earnings at the end of the day. You can't actually pay the bills with revenue just alone. Well, you can pay the bills, but you can't return capital to shareholders with just revenue. That's actually the most accurate way of saying it. Of course, you can pay bills with revenue. You do pay bills with revenue, but you don't pay the shareholders with revenue. You pay the shareholders with profits. All right, so just a little bit of a correction there. All right, so has anything changed today? Well, I'll start off by saying, or we'll actually probably go to the model and see for ourselves. Let's kind of explore ourselves and see. Okay, so TTCF. Okay, so let's let everything load in. It's got to wake up first. There we go. Okay, so there you go. You have analysts saying it's a buy. That's all you need to hear. I'm just kidding. But the price target is $12.98 by analysts, implying 72.84% upside. Again, like I discussed in the video when I reacted to the popular investor, I also do use analyst estimations. This model actually ports that in. And so taking a look at the revenue, okay, it's not actually porting in revenue estimates from analysts, because I guess it's not very well covered. Shares outstanding, we're gonna ignore all that. But I do believe that they are going to be a bit dilutive, if not a lot dilutive, because when we actually take a look at the cash burn rate, and we'll actually pull up the 10K in a second, I'm going to kind of walk you through my estimations for survivability, which is actually more accurate. When I did the Arrival stock video, again, there's a lot of people who really like that company. I don't know why. I responded to someone in the comments section saying that because they said I didn't look enough into the company, when I could say I looked enough to know I could X that company out. And I do believe that Arrival is more probable for us to do an analysis on survivability rather than it being a great investment. All right, but right off the bat, we're pretty much discounting. Actually, let me remove this for now. So if I were to say, no dilution whatsoever, but I think that's very improbable, okay, first of all. And I think they can achieve, for example, profitability rates around, let's say, 10% in, let's say, 5 years' time. Let's give them 5 years. So what is that? Yeah, almost 2027. So in 2027, they can achieve some semblance of profitability at about a 10% rate, and they work up to that. So that's basically what I'm telling the model. So I'm going to say in this instance, and let's actually remove these because we don't want that. No. Okay, so I see that the for example, buy point of interest would be $3.74, which is a decent chunk down from here. The scenario 2, we're not that far now from that price point. So after all this time, I do see that Tattooed Chef might end up becoming a interesting speculation if I really wanted to and put in the work. But the thing is, I'm not getting really that margin of safety. I'm applying no margin of safety here. If I have a low degree of confidence in this company, then I need to apply a greater degree of margin of safety. All right, so and that's where we kind of get to it. All right, so I do have to assume some higher levels of growth, and I think there's been a little bit of deterioration. Well, no, to be fair, in the other one, I went a little bit nuts, and I actually said that I would not expect, but in that example, I was comparing it to Conagra, and I went a little bit more aggressive, assumed they achieved something around 15%. And so you can see that if they achieve something around 50%, I want that margin of safety, and I still believe they can have to grow at 20%. It's about $3.77 that I'd be interested, which is a little bit lower from here. Not a little bit, but quite a bit. And then that 25% growth assumption gives me a buy price of about $5.58. So, interesting to note there. They are actually, or it seems that they are using more equity than debt at the present moment. And again, I do believe that there is going to be some levels of share dilution. So, and wrong, that's the wrong one. I do negative 2% there. So in that instance, I'm being a little bit conservative, I believe, but it would actually lower the buy prices for us. So we might see, because I think when it was trading originally in the close to 20 something, I know that the YouTube audience was perhaps maybe a little bit more pushbacky because it seemed like that was these prices were very far away. Well, it turns out today, and today is 5/10/2022. I'm recording this at 1:45 a.m. Eastern Standard Time. We are getting closer and closer to that buy price, okay, or point of interest. I'll call it point of interest because it's not necessarily a buy price. So that's kind of like the updated analysis. We're going to take a look at the 10K or the 10Q, whichever one I kind of find first, and I'll show you guys in a second what I'm finding. Okay, so I wanted to show you guys this real quick because I think this is very important. So take a look at the line item of cash, and actually I'll zoom in for you guys. So a good learning lesson or a good learning moment here. Take a look at that December 31st, 2021 to March 31st, 2022. Not too long after, we see a massive drawdown in cash. Now you see that inventory. Well, let's assume that, you know, they keep all that. That's the value. It's stated they're going to sell out inventory. That's going to be fine. Look at that accounts receivable. Okay, fine. It is growing. Okay, so we have to account for that. But there is still reduction there in cash. That implies some level of cash burn that's going on. And, you know, they don't have the statement of cash flows in here because this is an 8K right here. But taking a look at the adjusted EBITDA, you know, let's say that's a proxy for cash flows. Well, cash flows are negative. That's the operating income, for so to speak. And it's getting more negative than before. Okay, and we've already discussed as to why it is more negative than before, but you know the adjusted EBITDA is even better than the actual EBITDA. So actual EBITDA has been negative for quite some time. So let's assume, for example, for the sake of this, and we're actually just removing depreciation, and we are, you know, we're removing depreciation for the sake of this, but in this instance, well, we're removing interest, taxes, depreciation, all that. So for the sake of this, it is negative. We see a cash burn, and I want to show you guys because maybe this will kind of jolt your memory, because I did mention this in the live stream with Strongman, that take a look at the March 31st, 2021, just a year ago. And I remembered this off the top of my head because I do look at a bunch of stocks all the time. I remember Tattooed Chef having hundreds of millions of dollars. And I remember that individual that, you know, maybe you've heard of that talks about Tattooed Chef all the time. He was stating that the cash position was wonderful in the business. They have a lot of cash to play with. Well, where did all that cash go? Well, something that you can miss in your analysis is the cash burn and what we call a survivability measure, or the time it will take for the company to run out of cash. You want to calculate that. You want to be very careful with making a thesis based off of a current good-looking balance sheet. And I think, well, let's take a look at the long-term debt, which I don't think they had at the time. Long-term debt, current assets, liabilities, total current liabilities. Yeah, they didn't have any aside from the operating leases. But leases, by the way, are kind of like a debt because you do have to pay them. So operating leases, that's fine. So they didn't have any debt. They had notes payable actually right here. So they did have something, net of current portion. So, but nothing compared to what they had in cash. So it was very, very healthy. Now let's actually go to this one, this 8K, and let's see. Well, they have a line of credit. Okay, keep an eye on that line of credit, but that's still small. Accounts payable. Well, actually, let me actually take a look at their accounts payable. Accounts payable. It's comparable. So that's probably more the line of business. Warrants liability. Notes payable. Okay, so it's larger now. It is larger now. So again, but still nothing to be concerned of. So they are just burning cash. So that's what you want to be careful of. The cash burn and how much does this company have to last before they either have to issue debt or issue shares. I'm saying, in my opinion, it is of my opinion that they are going to issue either some form of debt, maybe in the form of preferred stock, or they're going to issue some shares. All right. I think the issuing shares is going to be the best one for them because they don't want to expedite the cash burn in the form of, you know, bonds or in the form of preferred stock. While you don't necessarily have to pay the dividend on the preferred stock, once you stop paying that dividend, it does accumulate. You do actually owe it. So because it is a form of debt, but it's a little bit more flexible form of debt rather than bonds. Bonds are very strict on ones you have to pay. Otherwise, you actually enter default. Okay. With preferred stock, you can stop paying for a little bit, but you owe it still. So, and then so it actually accumulates and you have to eventually pay it back. Or you have to pay the preferred dividend. Okay. It's not like common stock dividends where if they cut the dividend, then, you know, it's cut. It's whatever. Okay, so those are some thoughts that I wanted to share with you guys, and I'll end the video here. And thank you guys so much for watching. I hope you guys actually found some video or some value in this video. And if you did, go ahead and feel free to leave a like. Comment down below if you want to share your thoughts. Are you invested in Tattooed Chef? Are you thinking about Tattooed Chef? And yeah, I'll see you guys in the next one.